Correct for your introductory statement. We haven't seen you in a while. We need to hear your wisdom. Am I correct that you are playing this from the optimistic side? Is that a correct inference on my part?
Yeah, I'm with my old comrade Dennis Neal here. Look, what I'm reminded of today was the best piece of advice a money manager ever gave me about being long in the market. He said, do you want a smooth 10% a year or do you want a lumpy 15? This is a lumpy market over the long haul. Investors are going to do very well.
And Kevin Kerr, round us out. We have not seen you in a while. Thank you for coming back on the program. On the commodity point, gold, oil, what does it mean to you, Kevin? What does it mean to you? Is this the 1970s? What happens? How high? Give me a quickie, and then we're going to come back to everybody.
You're going to be surprised, Larry, because I agree with you. I think this is bullish for the economy, but for a different reason. And gold is here with the level we expected it to be at, and I think $1,000 is in reach, but it really isn't an inflationary indicator. It is a product of what we just talked about a second ago. We have a global community now trading these commodities that we did not have in the 1970s.
A global community. I really like that. That's a great point, by the way. That is a really important point. All right. Hang on, everybody. We're going to come back. It's time for a little something different on this program. I want to highlight some of these very key themes we just discussed. We are calling this Kudlow 101. And today, we are going to start with my argument that this is not the 1970s, folks. That is what we're going to start with. We're going to try to give it to you in 3 simple charts. Stocks say it's not the 70s. Bonds say it's not the 70s. And I say it's not the 70s. Let's go to the first chart. Let's look at the 1970s. Look what happened. Oil prices rising in the 70s. Stock prices falling in the 70s. That was global inflation. That was high tax rates. That was crazy wage and price controls and overregulation. Now look at the difference with the 2000s. Stocks and oil are going up together, as the brilliant Rich Karlgaard and Kevin Kerr just observed, together. That is a global economic growth signal. That is not an inflation signal. And let's go to the third simple chart. Let's look at the message of the bond market. Commodities and the 10-year bond rate. Please notice, in the 70s, they both went up together. That was inflationary. Heck, bond rates, I think, probably reached 15% at one point. They've been sliding down for several decades. Now look at this. Commodities booming higher, bond rates rock bottom, just above 4%, call it 4.5%. It's actually 4 1/3%. Today is the day of low tax rates worldwide. Today is the day of strong global capitalism creating high demands for commodities. Production can't keep up. That's all that's going on, so the prices are high. By the way, we'll look at constant dollar prices. They're not even close outside of oil. This is not the 1970s. We should not be panicking. Now I want to go back and get my distinguished panelists, and let me go to Kevin Kerr. That's just where we left it, Kevin. What's your comment? Those are 3 quick charts, Kudlow one-on-one. Take it from there, Kevin. Continue your thought.
You hit the nail on the head, Larry. You know, adjusted for inflation, gold should be at about $1,600 right now. We're not even halfway there.
I think we got some charts. I don't mean to interrupt your flow. We got some charts on constant $2,007 for gold and the commodities index. Gold, yeah, I mean oil, yes, absolutely. But not these other commodities. Maybe we'll get them on the chart full screen, Hope Springs Eternal. There they are. Constant dollar oil is there. No question about it. Now let's shift into a commodities index or the constant dollar gold price. Constant dollar gold is nowhere near.
Exactly.
We're at $830 today. The peak in relative terms would have been $1,400. And I think we have an all commodities index where we see a similar. There it is, CRB spot. Look at that. So, Kevin, I'm just making the case. Global spread of capitalism, supply-side tax cuts, as you yourself said, fabulous financial technology so everybody can be trading and buying and selling. Isn't that's the deal. Commodities are going up, maybe for good reasons, not bad.
Exactly, and we have a burgeoning middle class in not only China, but India. We hear that story all the time, but it's true. You know, we have a growing middle class that demands not only soft commodities and agricultural commodities, but certainly energy. So this is a big demand picture. you know, and that's positive for the economy. I mean, it's a little painful, you know. Initially, nobody wants to see higher prices, but it's an indicator that the world is growing and more commodities are in demand.
Dennis Neal, you have a different thought on that. You think I'm wrong. You think this is the 70s.
No. You're entirely right. And you left out one other encouraging squiggly line on the graph. And if you went to 1990, when oil hit a high in 1990 at $40 a barrel, and inflation was at 5.1%, and then you go all the way through to 2007, when oil has hit a high of $98 a barrel, and inflation is down at 2.3%. So what are we whining about? This is like the old Pretenders song, Stop Your Sobbing.
All right, now, Brian Westbury, you are worried we're moving in the direction of the 1970s. We love to have a contrary view in the spirit of free market capitalism, not to speak of free speech. Brian, go ahead.
Yeah, well, first of all, I don't think the 70s are here yet. I do worry that we could repeat those. And there's two things that are different today than were back then. Back then, there was not a global economy. In other words, we were the dominant power. Socialism was everywhere around the world, and it was on the climb. And I really believe that the stagflation of the 1970s started in